Folks, I want to talk about momentum. I've talked about momentum about a week ago, and I've received some emails from traders who are getting worried about the current momentum levels. And you should have a good reason to, especially after I show you the following. Now, if we look at the S&P 500, you will see that the price of the stock, let me just remove one of these studies. We're getting a little, I don't like when it's too clouded. But if you look at the S&P 500, especially right now, you will see that we're hovering around the 200-day moving average. Matter of fact, this looks to me like a descending triangle. And honestly, I want to be wrong on this. I don't want to be right here. But that looks like a descending triangle, more or less. My drawing skills may not be that perfect, but you get the point. The point is, we're still hovering around the 200-day line, and it looks like we're getting closer and closer to breaking it. And if it breaks down, there's a good chance we're going to start getting bearish once again. Most importantly, I'm seeing a couple of confirmations of that. I'm looking at the put-to-call ratio, and we bottomed out and we peaked out to 100, but we're already at 0.79. And usually when the put-call ratio gets 75, 70, it tends to revert back, and that means the market tends to move down. Remember, the put-to-call ratio is inverse. When it's too low, that means the market's too high. And when it's too high, the market's too low. So the fact that we're moving towards the down part, 0.75, that's telling us that the market may be a little bit overbought at these levels. More importantly, and the put-to-call ratio is a great indicator, but it's very noisy. It has a lot of noise. It only works at extremes. Like this is an extreme, this is an extreme, these are extremes. But it looks like we could be coming down to that level, and it already is kind of stretched out. But here's what really bothers me. If you look at the overall stock market, and this is stocks that are trading above $2 per share, only 38% of stocks are trading above the 200-day moving average. And I'm going to tell you something else. If you look at the S&P 500, the number's not all that different. Let me show you this. It's just taking a second here to load, but you could see here that only 41.38 or 41% of stocks are trading above the 200-day moving average, which is telling me that 59% of stocks in the S&P 500 are still in a bear market. I know, the S&P is above the 200-day moving average, but remember, you've got a lot of market cap in stocks like Amazon, Microsoft, Intel, Nvidia that are propping market cap higher. So the bigger stocks have a bigger vote or more say when you're looking at the chart. But when you're looking at the markets internally and you're seeing 41% of the stocks above the 200-day moving average, that doesn't make me feel warm and fuzzy. And I'm going to tell you something that's even making me feel worse than that. The percentage of stocks trading above the 50-day moving average is above 80th percentile. Now, I showed you this a few weeks back, and I told you guys to be careful, and this is where we were. We're moving down a little bit now. Remember this little box? I showed you this about a week ago. I purposely wanted to wait about a week to do this demonstration. We were all the way at 95th percentile. We're now at 80th percentile. And as you could see, the market is cooling off. Well, I'm expecting this rubber band that's stretched out. Look at this. This is the highest level in 20 years. This is a 20-year max chart. It only goes 22 years. Let's see here. This actually goes back 12 years, but we could go back 20 years. We can go further back. Let's see here. Nope, it actually goes back to 2006. But the point is, and you could see here, this is 14, 15 years. You could see here, every time we stretch out, we go low. Every time we stretch out, we come down. Every time we stretch out, we go down. Every single time. Every time. And this is the highest level yet. And look at what happened previously to that. We were stretched out just in the other direction in February. This here is what led to this downfall. And I believe this went here and it took us all the way down, and that was the correction. And now we're back up, but again, we're moving lower. So in my opinion, because you've got the big trend, the long-term trend, only 59% 59% of stocks are trading below the 200 days. So there's a clear 200-day line with stocks, almost 60% of stocks trading below the 200-day line. And you've got 80% of stocks above the 50-day line, and that's overbought, especially coming off the 95th percentile. So that's telling me that the market is going to cool off and continue cooling off, mostly the broad market. Maybe not the tech, maybe not the health, maybe not the consumer discretionary, but most energy stocks, utility stocks, consumer staples, financial stocks, I'm looking for more downside. So you've got to be extra picky till we see the 50-day line oversold. All right, it's overbought right now, and we need it to get oversold. And by the time the number of stocks goes from 80th percentile trading above the 50-day moving average to 30th percentile, that's going to put the number of stocks in the 200-day line a lot lower as well. So what you're seeing is you're seeing a predominant trend that's still bearish, but stretched out to the tilt to the upside coming down. So it's like a pullback. Imagine you're trading long and you see a pullback to the downside. This is a perfect pullback to the upside, but the long-term trend is still down. Taking that with the fact that, let's look at VIX, that volatility is still, look at volatility, it's still at 30. Anything above 20 is fear zone. And we're still above 30. The markets are not stable. Don't let the fact that the S&P is trading above the 200-day moving average to make you feel warm and fuzzy. Because when you look at the internals, things are not looking nowhere near that. The market is still bearish. It's a little more neutral than it was before, but there's a lot of fear in this market, and that's why institutional traders are still sitting on the sidelines. Now, it doesn't mean it's a harder market to trade. It's actually an easier market to trade because you have less stocks making higher highs, but the ones that are really ripping it apart. So you got to be a little more selective, and you've got to be a little more careful right now, and you may want to lower your exposure just a bit because the market in the short term is stretched out, and in the long term, it's still demonstrating bearish bias. I hope that helps. Folks, I recently received a small USB in the mail from legendary trader Tom Busby, this one right here, and what's on it has blown me away. I've seen a lot over the years, working with different hedge funds and traders, but this is something else. Tom Busby has discovered a strange phenomena that's been causing hundreds of stocks to increase in value on the exact same day every single year. I'm going to repeat this. The same stock goes up every single year on the same date. It's unbelievable. I'm talking about stocks that explode as much as 350% on the same day year after year. Click on the link below to see the shocking details inside this tiny black device. Do it now.